1720. A British widow invests her life savings in a company that promises gold from the New World. The stock multiplies by 8 in 6 months. She's rich until she isn't. 1721. A California programmer quits his job to day trade tech stocks. His portfolio doubles in 3 months. He buys a BMW. 6 months later, he's bankrupt. 1722. You check your retirement account. It's up. Your home value. Up. Your crypto. Up. Everything's up. You feel rich, but here's what nobody's telling you. So did they. Right before they lost everything, 3 centuries, 3 bubbles, same pattern, same stages, same ending. And if you've watched your net worth climb while your grocery bill drains your paycheck, you're living in the setup to the same story. The question is, are you the widow, the programmer, or the person who sees it coming? To understand what's happening right now, we need to go back, not to theory, to documented moments when entire nations convinced themselves that wealth could multiply forever. When smart people made catastrophic decisions, when the phrase "this time is different" echoed through markets right before the collapse. History doesn't repeat, but it rhymes, and right now, the rhyme is deafening. What I'm about to show you isn't taught in finance classes. It's too uncomfortable, too revealing, because it exposes a pattern that's played out 3 times in modern history, and we're deep into the 4th cycle right now. Here's what nobody tells you. Every major financial bubble follows the same 5 stages. Displacement, boom, euphoria, profit-taking, panic, every single time. The South Sea bubble of 1720, the dot-com bubble of 2000, and now, the everything bubble of 2025. If your home value doubled while your salary crawled, up 3%, that's not just a good real estate market. If your stock portfolio hits records while inflation devours your savings, that's not just smart investing. You're in stage 3 of 5, the stage where everyone feels wealthy, the stage right before the wealthy start quietly selling. Let me take you to London, 1720. The city is exploding with prosperity. Coffee houses buzz with stock tips. Servants discuss their investments. A new company, the South Sea Company, promises unimaginable wealth. It holds exclusive rights to trade with South America. Gold, silver, unlimited riches. The stock price tells the story. January 1720, it's £128. By June, £1,050. That's a 720% gain in 6 months. Source: Edward Chancellor. Devil take the hindmost. A history of financial speculation everyone's buying. Dukes, merchants, maids, even Isaac Newton, the greatest scientist alive, invests heavily. "I can calculate the movement of stars," he famously said, "but not the madness of men. But beneath the surface, something's breaking." The South Sea Company isn't trading much with South America. Spain controls those ports. The profits are fictional. The stock price is pure speculation. But nobody wants to hear this. Everyone's getting rich. Here's what they missed. 3 warning signs appeared. First, the company started issuing more shares to keep prices rising. More supply, same demand. Basic economics says that ends badly. Second, bizarre copycat companies emerged. One offered to create perpetual motion machines. People invested anyway. Third, insiders started quietly selling while publicly proclaiming confidence. Sound familiar? Your Tesla stock split? That's sign 1. Your neighbor's cousin's NFT business, sign 2. Billionaires talking about holding while SEC filings show them selling. That's sign 3. September 1720. The whispers start. Maybe the South Sea Company isn't worth £1,000 per share. Maybe it's worth nothing. The first investors try to sell, then more, then everyone. By December, the stock crashes to £124. 90% of the gains vanish. Source: Richard Dale, The First Crash. Lessons from the South Sea Bubble. Let me tell you about Elizabeth Bentley, a London widow. 52 years old in 1720. Her husband died 3 years earlier, leaving her £800 as life savings from 30 years as a textile merchant. It was enough. She could live modestly, comfortably, for the rest of her life. Then came the South Sea fever. Her neighbors doubled their money. Her church friends tripled theirs. In June, she invested all £800 at £950 per share. By September, she was a paper millionaire. By December, she owned stock worth £64. Her life savings gone, not gradually. In 90 days, she died in a poorhouse in 1724, age 50. Source: historical accounts compiled in the Great Mirror of Folly. That's what bubbles do. Not to companies, to you, to real people with real savings. The wealthy insiders. They sold at the peak. Elizabeth bought what they sold. This collapse set a pattern, a template. Over the next 280 years, it would repeat. Each time with new technology, each time with the same psychology. Fast forward to March 2000. The internet is changing everything. Companies with no revenue trade at billions. Pets.com, EITOS, web van names that promise to revolutionize commerce. The Nasdaq hits 5,048 points. It's doubled in 12 months. Source: Nasdaq historical data. Silicon Valley programmers become millionaires overnight. 25-year-olds buy Ferraris with stock options. Everyone's quitting their jobs to day trade. Books promise wealth through tech stocks. The phrase "new paradigm" is everywhere. The old rules don't apply anymore. Technology changed everything. But here's what they missed. The same three signs appeared. Companies with zero profits had billion-dollar valuations. Copycat firms emerged. Denny Company, adding doublequotes.com to its name, saw its stock soar. And insiders, they were selling, quietly, relentlessly. March 10th, 2000. The top. Nobody knows it yet. The Nasdaq starts falling, slowly at first, then catastrophically. By October 2002, the index hits 1,114. That's a 78% collapse. 2.5 years of devastation. Source: Federal Reserve Economic Data. Meet David Shen, a San Francisco software engineer, 28 years old in 1999. His company went public. His stock options were worth $2.4 million on paper. He felt invincible. He bought a condo in Pacific Heights for $850,000. Quit his job to day trade full-time. March 2000 arrives. His portfolio is worth $3.1 million. By December 2000, it's worth $340,000. By 2002, he's bankrupt. The condo foreclosed. His career derailed. He spent the next decade rebuilding what he lost in 18 months. Source: .con by John Cassidy. That's what euphoria costs. The promise of endless wealth. The certainty that this time is different. The belief that technology eliminated risk. It didn't. It just disguised it. Notice something. The same pattern. Different century, different technology. Same 3 warning signs. Same 5 stages. Same ending. That pattern went unlearned. The lesson forgotten, until it repeated again in 2008. But here's the twist. 2008 was different. Not in pattern, but in response. The government intervened. Massively. They printed money. They bailed out banks. They dropped interest rates to 0. The system didn't collapse, it inflated. And that inflation created something unprecedented. The everything bubble. 2009 to 2025. 16 years of asset price inflation. Stocks. The S&P 500 went from 735 in March 2009 to over 5,800 in late 2024. Source: S&P 500 historical data. That's a 690% gain. Real estate. The median home price climbed from $173,000 in 2009 to $417,000 in 2024. Source: Federal Reserve Economic Data. That's a 141% increase. Your 401k looks healthy. Your home equity is up. You feel wealthier. But here's what the numbers hide. Your actual purchasing power is eroding. Because while your assets inflated, so did everything else. And here's where it gets critical. The same 3 warning signs are flashing, all of them simultaneously. Right now, warning sign 1, unprecedented debt. As of October 2024, U.S. national debt stands at $35 trillion. Source: U.S. Treasury Department. That's 123% of GDP in 1720. Britain's debt was 120% of GDP when the South Sea bubble burst. In 2000, household debt hit record levels before the crash. The pattern repeats. Warning sign 2, speculative mania. Not in one sector, in everything. Meme stocks, NFTs, cryptocurrency, SBACs, billions flowing into assets with no earnings, no revenue, no fundamentals. GameStop traded at $483 in January 2021. Why? Because Reddit said so. Source: Bloomberg market data. That's not investing. That's casino behavior masquerading as wealth creation. Warning sign 3, insider selling. In 2024, corporate insiders sold at the fastest pace in 2 decades. Source: Washington Service Insider Trading Data. They're not buying their own company stock, they're selling it to you. But here's what makes 2025 different 10 more dangerous. In 1720, only the wealthy played the market. In 2000, it was mostly professionals and speculators. Today, it's everyone. Your Uber driver has crypto, your hairdresser day trades on Robinhood, your college student has a brokerage account. The entire population is exposed. The bubble isn't in stocks, or real estate, or crypto. It's in everything simultaneously. That's why they call it the everything bubble. And when everything is inflated, the collapse affects everyone. So what does this mean for you? For us? For right now, it means your grocery bill is telling you something your investment account isn't. Eggs cost $6 now. They cost $2 in 2020. Source: USDA Price Index, October 2024. That's real. That's not on paper. That's the gap between asset inflation and purchasing power erosion. Your rent, up 35% since 2020 in major cities. Source: Zillow Rent Index, September 2020 for your healthcare premiums, up 30%. Source: Kaiser Family Foundation, 2020 for your student loan payment, still $503 monthly while your rent consumes $1,800. Source: Federal Student Aid, 2024. You might feel wealthy on paper, but can you afford to live? That's the question Elizabeth Bentley faced in 1720. That's the question David Chen faced in 2000. That's the question millions are facing right now without realizing it. But we have the Federal Reserve. You might say they won't let it crash. They said the same thing in 1720 about the Bank of England. They said the same thing in 2000 about Alan Greenspan. The Fed can print money, it can't print productivity. It can't print real wealth, it can delay, it can inflate, but it can't eliminate cycles. This time is different. We have technology, AI, blockchain. In 1720, they said the new world's gold made it different. In 2000, they said the internet made it different. Technology doesn't eliminate human psychology. It amplifies it. The bubbles get bigger. The crashes come faster. Here's what history teaches. Bubbles always burst. Always. Not because of some external shock. Because the mathematics eventually matter. When debt exceeds income, when prices exceed productivity, when everyone's borrowed from the future to spend today, the future eventually arrives and demands payment. 3. Bubbles. 3 centuries. Same pattern, same warning signs. Same tragic human stories of wealth gained and lost. Elizabeth Bentley trusted the system. David Chen trusted the narrative. Both lost everything not because they were foolish, but because they believed what everyone around them believed. The everything bubble of 2025 is different only in scale. More people, more debt, more assets inflated, more to lose. We're in stage 3, maybe stage 4. Euphoria, transitioning to profit-taking. The smart money is quietly repositioning. The insiders are selling. The question is, are you buying what they're selling? 300 years of financial history compressed into one pattern, 5 stages that repeat with mechanical precision. And right now, your retirement account, your home value, your crypto wallet, they're all caught in a cycle that started long before you clicked buy. So here's what I can't stop thinking about. Knowing the pattern doesn't mean you can time it. Elizabeth Bentley knew the South Sea stock was expensive. She bought anyway because everyone else was. David Chen knew tech stocks were overvalued. He quit his job anyway because the gains kept coming. The pattern is visible. The timing is impossible. Are we the generation that finally breaks the cycle? Or are we just the next chapter in a 3-century story of euphoria, denial, and collapse? Is your portfolio wealth real, or is it paper wealth waiting for reality to reassert itself? When did you first notice the disconnect? When you couldn't afford rent despite record employment? When your grocery bill doubled while economists celebrated low inflation? When your savings grew on paper but shrank in purchasing power? Drop a comment below. I read every single one, because your experience might be the early warning the rest of us need. If this connected dots you hadn't connected before, if you're seeing the pattern for the first time, hit subscribe. Every week, we dive into the cycles they don't teach, the patterns that repeat, the warnings hidden in history. The next video will explore what happens in Stage 5 and the decisions that determine who survives and who doesn't. Thank you for watching this through. 3 bubbles, 3 warnings, 1 pattern. The question isn't whether it bursts, the question is when, and whether you'll see it coming. I'll see you in the next one.